Global markets are mixed as traders debate just how certain a Fed rate cut is next month. New Zealand's retail sales volumes are stronger than expected, and Singapore's inflation is weaker than forecast. That's coming up in our 5 Things in 5 Minutes on Monday, August the 25th. And then in part 2 of our deep dive interview with ANZ senior commodity strategist Daniel Hynes, he unpacks the role of Chinese investors funding Indonesia's aluminium expansion.
The incentives that the Indonesian government are providing provides an attractive proposition for a lot of these Chinese smelters.
But first, in 5 and 5 with ANZ, markets were mixed overnight, with investors still digesting Jerome Powell's relatively dovish speech, in which he said the Fed can start cutting rates again next month. Here's ANZ Group Chief Economist Richard Yetzinger on the messages being digested from that Jackson Hole speech.
There were two big messages around monetary policy, which is what people tend to kind of imbue out of that event. The first was the Fed is shifting to targeting average 2% inflation. It's the idea of a make-up strategy that it took on after the pandemic has been formally retired. Not a big surprise, but that formal decision was given. The second issue is a more downbeat assessment, I think, of near-term economic conditions, such that the market has become emboldened about thinking the Fed will cut rates imminently. We agree with that and expect the Fed to cut rates in September.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was down 0.1%, the Nasdaq up 0.2%. The US 10-year Treasury yield was flat at 4.269%, and the 2-year rose 4 basis points to 3.72%, as a few doubts set in about next month's Fed cut. Gold was flat at $3,415 an ounce. West Texas oil futures up 2.1% at $64.98 a barrel on concerns by traders that Russian supplies could be disrupted by sanctions and Ukrainian attacks on oil infrastructure. The US dollar index rose 0.5%. The Aussie dollar was flat on 64.92 US cents, and the Kiwi was down 0.1% at 58.59 US cents. Number 2. New Zealand's Reserve Bank pivoted last week from being on hold, worried about inflation, to cutting 25 basis points and being much more worried about growth, with 2 of the 6 decision makers actually voting for a 50 basis point cut. ANZ's New Zealand Chief Economist Sharon Zollner thinks that shift could flow through quickly into better confidence.
The impact on confidence could be quicker if people really take on board the message that, the Reserve Bank's got the economy on a tight leash to the Reserve Bank's going to do whatever's needed to get this economy going again. That's quite a different vibe. But of course, what's hard to know is how much have we talked ourselves into a funk versus how much are we just facing significant headwinds that are just going to take a lot to overcome.
Number 3. Singapore's annual inflation rate in July fell unexpectedly to 0.6% from 0.8% in June. Core inflation also nudged lower to 0.5%, says ANZ's Head of Asia Research, Koon Goh.
Now, the main contributing factor to the downside surprise was weaker than expected retail goods-related prices and also lower transport services prices. Now, I think that reflects a combination of a strong Sing dollar, which is exerting downward imported price pressure, and also probably intense competition in combination with a slight weakening in demand. The MES notes that they now expect unit labor cost pressures to ease on the back of productivity improvements and also moderate wage gains.
Number 4. So what might the Monetary Authority of Singapore think about this softer inflation? Here's Koon again.
So overall, inflation in Singapore is low and well contained, but we see very little risk of it slipping into deflation. Although the inflation numbers are running below its long-term average, I don't expect the MES to ease policy further this year. That's because I anticipate inflation to start to pick up from Q4 onwards as base effects become less favorable and the lag effects of the strong Sing dollar starts to weigh.
Number 5. Back to New Zealand, there was some better than expected news from the retail sector yesterday, with retail volumes in the June quarter rising 0.5% from the March quarter. Economists had expected a fall. ANZ senior economist Matt Galt pointed to strength in volumes in electronics and department stores, where lower prices boosted activity, but it was relatively widespread, with 10 out of the 12 industries reporting growth.
The weight of the data still suggests that the economy was quite weak over Q2, and the Reserve Bank had revised their forecast down to minus 0.3 quarter on quarter in their monetary policy statement last week. Possibly this data takes off some of the worst fears of a steep decline, but on balance, we'd still say there's downside risk to our own forecast of plus 0.1% quarter on quarter.
Matt Galt there. Now, on part 2 of our deep dive interview with ANZ senior commodity strategist Daniel Hynes about Indonesia's nickel-style supply expansion in aluminium, he talks about the differences that mean the strategy might not work as well for nickel. But firstly, I asked about the role of Chinese investors and their experience in Guinea.
Guinea actually evolved as the world's biggest supplier of bauxite ore to China as a result of Indonesia's export ban that they implemented back in 2014. And that saw obviously a lot of Chinese smelting companies go to the African nation to purchase their ore to feed into their facilities in China. We're now seeing Guinea start to put up sort of roadblocks to the export of that ore, and that has resulted in these Chinese smelters looking at other avenues. And certainly the incentives that the Indonesian government are provides an attractive proposition for a lot of these Chinese smelters. So they are obviously piling a lot of money into developing within Indonesia, the refineries and smelters to produce that finished product.
And looking at the quality of Indonesia's bauxite relative to others, and also the different things you need to do to bauxite to turn it into something useful, in particular the role of electricity. So what's the differences there?
Yeah, well, I suppose the issue that the market is confronted with in aluminium is the relatively high cost of energy. And aluminium is sometimes referred to as a solid form of electricity because it takes up a huge amount of the costs to refine the metal. In fact, it can be as high as 40%, the base cost, essentially, to produce a tonne of aluminium. And so that's always been an issue for aluminium smelters. And certainly in Indonesia itself, they've been struggling with the strong demand for power and how to feed that. And they've been heavily reliant on coal-fired power generators as a consequence. That's not particularly helpful for the environment and for the emissions they produce. So it's clearly an issue the aluminium market needs to look at. But first and foremost, it'll be a challenge for a lot of these Chinese developers if they were all to look to move to construction phase. There would be some serious question marks over whether they could get enough power really to run these aluminium smelters.
So putting all that together, the difference in the backgrounds to aluminium versus nickel and the increased need for electricity and particularly the issues with using coal to produce it in Indonesia, is there a prospect that Indonesia's pivot into aluminium could see a similar price effect in aluminium as we saw in nickel?
Look, I think the headwinds are just too great to really see the same thing evolve that we saw in nickel. As you say, the energy costs, will be quite a significant challenge. The aluminium market hasn't developed, a revolutionary new process to access this new ore, and so it'll really come down to the will, I suppose, of the Chinese companies to really push and increase investment in that country based purely on economics, and that certainly will face a lot of hurdles. So I suspect it's going to evolve, but certainly not to the way that we've seen it really upheave the nickel market. And so I think that the concerns that we'll see a flood of aluminium are probably overdone.
So what's your view then for the aluminium price by the end of next year?
Well, I think we can see prices push higher. I mean, certainly the economic backdrop is challenging at the moment, but I think those supply constraints will keep the aluminium market in deficit, and we would expect to see them, up around the $2,800 a tonne mark by the end of next year, which is, a decent enough rise from where we're seeing at the moment of around $2,500.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, August the 26th. Catch you tomorrow with a deep dive interview with ANZ Group Chief Economist Richard Yetzinger on how developed economies are now grappling with low birth rates and the prospect of falling populations relatively soon. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.